Question number 5. Best Food Private Limited is engaged in the business of buying and selling dairy products. The following ratios are available for the company and its industry. Ratio, turnover ratio, financial year 2019, 2018, industry financial year 2019. Turnover, inventory turnover 80, 55 and 65. Total assets turnover 0.7, 0.8 and 0.6. Accounts receivable collection period 125, 110, 130. Debt to equity 0.9, 0.85 and 0.95. Total assets to equity 1.9, 1.85, 1.95. Interest cover 1.35, 1.85, 0.85. Profit margin 12%, 11.5% and 12.5. Required, calculate the following based on the available ratios and comment on it. Return on capital employed ROCE for BFL for the financial year 18 and 19. ROCE for the industry for the financial year 19. Return on capital employed. Return on capital employed for the financial year 2018 and 2019. How do we take it? Normally, profit before interest and tax divided by total assets minus current liabilities. And you know ROCE is a combination of two dimensions. One is the profitability, the other one is the efficiency. So, it is like you studying for your exam. You know the subjects ins and outs, all the accounting standards, consol, the interpretations, corporate governance, non-financial reporting, everything. But for you to complete the paper, you struggle to finish it within 3 hours, you need minimum 6 hours. You will fail. And someone will be pretty fast in doing the questions, but he does not have time to study. Busy with other works. He does not know the subjects. And he does not even know, he can't even remember the name of the subject. Fail. So, you knowing the subject ins and outs, it is like you having the profitability, you need to have the required markup and the margin. And no matter how much of a margin or a markup you try to maintain, if you can't sell the goods, you are not efficient enough to achieve the required and desired objectives. So, now for you to achieve or for you to secure at least 50 minimum marks at the exam, you not only will be required to know the subjects, also will be required to work the paper to answer 6 or 7 questions within 3 hours. Efficiency matters the most. Equally, the knowledge and the technicality of the subject also matters the most. So, it has to be a combination of the technical knowledge plus the efficiency. Likewise, for the ROCE to improve, there are 2 dimensions, there are 2 areas basically. One is the profitability, you need to multiply profitability by the efficiency. Profitability will be what? Profit before interest and tax divided by sales, profitability. Efficiency will be what? Sales divided by total assets minus current liabilities. And then eventually your ROCE calculations will be this: profit before interest and tax divided by total assets minus current liabilities. Don't expect the life to be too rosy always. Don't expect the examiner to give informations directly straightforward, no. Don't expect anyone else to come and start feeding you, keeping and holding you on his hands or her hands. And you should be determined enough to tackle the questions with the technical knowledge you have. Here the examiner gives the required informations, but it by just beating about the bush, indirectly he has given the informations. And let's see how to do the calculations for 2 years, 19 and 18, 2019 and 2018 rows. Profitability is given, assets turnover is given. Assets turnover should be the measure of the efficiency, and here profit margin should be the measure of the profitability. For 2019, profit margin is 12%. This is multiplied by the efficiency ratio, that is the total assets turnover, 0.7. For the last year 2018, profitability margin is 11.5 into the assets turnover, 0.8. So let's take the answers. 12 into 7, this is 8.4. 11.5 into 0.8 should be 9.2. So the rows has declined from 9.2 to 8.4. Let's see why the decline has been what it is for. And before that, let me also work out rows of the industry for 2019. Profit margin industry, profit margin 12.5 into the efficiency ratio, which is the total assets turnover, 0.6. 12.5 into 0.67.5. Now, what is the ultimate interpretation of the rows? This is the ultimate interpretation of the rows. You being able to have 8.4% of rows for the year of 19 means that for every single 100 rupee capital you invested, you have earned a profit of 8.4. For every single 100 rupees worth of capital you invested in the company for 2019, you have been able to generate a profit of 8.4. And last year 9.2, industry, all the businesses that operate within this sector has been able to generate 7.5 worth of profit for every single 100 rupee worth of investments. So that is how it is interpreted. Now, for better understanding, you can compare this with your cost of capital. Say for an example, you have raised all your finance through a bank loan for which you are supposed to pay 12% interest, and your business is not worth at all. You just shut it down and just wait without doing anything, and that is more profitable. Why? For every 100 rupee worth of capital, how much does your business earn for you? 8.4 rupees, but how much is your commitment to the bank? 12 rupees. Are you making profits? Nonsense. So this rows is a very sound calculation, very strong calculation, and you can take lot of decisions based on rows. Now you need to comment on these calculations, comment on the calculations. Let me start with 2018. Here 9.2. It is fairly a better ratio compared to 2009. That is not your comment, but you need to see, you need to notice a slight decline in rows in 2019, and you know, for the rows to change, either efficiency level has to change or the profitability should change. So, what has changed? Efficiency in 2018 has been little better than that in 2019. Efficiency level in 2019 has dropped by 0.1, and the profitability in 2018 has been little lower than that in 2019. So, the incremental effect of the change of the profitability has been lower than that of the efficiency. I hope you got the point. Even though the efficiency has dropped, in 2019, profitability in 2019 has increased, but the effect on the increase in the profitability has been of no use. Why? Overall, ROAS has declined from 9.2 to 8.4%. But anyway, over the 2 years of 18 and 19, the company has been able to keep their ROAS well above industry average, well above everyone else who operate in the industry. So, that should be the comment. So, if you comment about ROAS, you need to comment about two things: efficiency and profitabilities. So, you are very good in the class, you answer all the questions that the teacher raises, but later on you fail the paper, and then the exam or the teacher will just do a small follow up and a review, and then only we understood, look, though you have increased your volume of reading, you never practice writing the answers for the questions, and you lack deficiency, and that is what you made that is the reasons why you could not succeed at the exam. So, you need to look at two dimensions in evaluating ROAS. In commenting on ROAS, you need to look at profitability and you need to look at the efficiency as well. So, let us look at the answers of the examiner. He has done the calculation 8.4, 9.2, 7.5. The ROAS of the company for 19 has been down compared to 2018, mainly due to the lower asset turnover despite the improved profit margin. However, the asset turnover of the industry is still lower than that of the company. Hence, the ROAS of the company for 19 is slightly higher than the ROAS in the industry, although the profit margins is not as good as the industry average. We are now moving on to part B of the question. Discuss the following areas of BFL based on the available information: asset management efficiency, solvency. To discuss on the asset management efficiency, you need to look at all turnover ratios. Sorry. We will look at all the turnover ratios. And also you need to remember nature of the products that they deal with. What are the products that they deal with? Dairy products. What are the examples for dairy products? It can be yogurt, it can be fresh milk, it can be cheese, it can be butter, and so on and so forth. The nature of the dairy products will be such, they perish within a shorter period. You can't hold on to inventories for a longer period, perish. Now, if you see the manufacturing date of a yogurt, the expiry date may be just in 8-7 days. So, the seller should be able to sell it within just maximum 1 week's time. So, that information and knowledge also will be important. Assets management efficiency. Inventory turnover has been 55, now is 80. Number of times the inventories turn into sales has been 80 times in 19, it has been 55 times in 18. And if you sold only 55 times in 18, if you sold 80 times in 19, what does it say? There is a significant improvement in the efficiency level in 2019. So, that is good. Total assets turnover 0.8 last year, 0.7 during the current year. Now, there is a decrease. So, these two are now moving to the opposite directions. Inventories are sold more than what we could sell during the last year, but total assets turnover has dropped. Some of the assets in the company remain idle, no production. Why? Either because no raw materials, or maybe pandemic situations like what we are experiencing now, or labor strikes, or machines breakdowns, or inexperienced labor, they do not know how to do it, recruitment issues, HR policy issues, and so on and so forth. Lot of reasons can cause the assets to idle, and that will drop down our total efficiency level. And accounts receivable collection period, last year 110, current year 125. Now, some informations are coming to light, and certain facts of information is now becoming obvious. Why? Now, the credit collection from the customer is dragged from 110 days to 125 days, from 110 days to 125 days. And it is an extension by how many days? 15 days. What do you think should have happened here? Maybe we would have had some inventories partly obsoleted, or maybe a new product, and you need to bring this new product to the customers, and you started selling more of your inventories on credit basis. So, we are persuading and motivating the customers to buy our products. Just to persuade and make our customers to buy our products, we need to give them kind of a benefit. So, we have extended our credit period. The longer the collection period, the higher the value of the debtors, and the longer the credit period, the more motivated the customers are to buy our product, and that would have been the mechanism we implemented to have our inventories turned over. So, we have extended the collection period. So, the customers are happy, they started buying our inventories more and more than the last year. So, the inventory turnover would have gone up, but maybe our production is not as efficient as it was. We are selling the existing inventories, but by and large our factory is not working, factory is now idling, maybe short of raw materials, maybe labor strikes, poor HR policies, whatever the reasons, most of the assets in the company are idling. So, that is what you need to give as part of your answer for B. Assets turnover or assets efficiency or assets management efficiency. Inventory turnover has increased, but that is because we have given extended credit period for the customers to settle their dues, maybe to get our inventories sold fast. Maybe we would have had some obsolete inventories, or we would have had some new products which the customers are not familiar with, and part of the business is idling. Most of the assets in the business are idling. Even if the inventory turnover has increased, entire efficiency level has collapsed. So, that is what you need to write. Solvency, to comment about or to discuss about solvency, you need to look at debt to equity ratio, interest cover, total assets to equity. Debt to equity ratio has been 0.85 last year, current is how much? 0.9. Debt to equity, debt has increased. So, the company is now heading towards a gearing position. Interest cover 1.85, this is 1.35. The higher the gearing position is, the bigger the interest component, and then the coverage ratios will come down. That is what has happened. Total assets to equity, that has slightly increased from 1.85 to 1.9. So, despite that fact, by and large, overall gearing position is now increasing of the company. Why? Because debt to equity ratio has increased and even the coverage, interest cover ratio has come down. Why? The higher the gearing position is, the bigger the interest component should be, and that will bring down the coverage ratio. So, you can look at the answers given by the examiner. Inventory turnover has increased compared to 18 and it is now above the industry average. This is commendable since dairy products are naturally perishable with a short lifespan. In 19, it means that every 4.5 days the company is able to sell its inventories as opposed to the industry average of 5.6 days. Accounts receivable collection period have gone up compared to 18, but it is still better than the industry average. So, while the company is able to turn inventories around quickly, it seems to have trouble collecting the sales, although it is doing better than the industry. This may be due to achieving sales targets on credit sales through no or low quality credit evaluations. The total assets turnover has come down compared to 18, it is still higher than the industry average. This reveals potential problems in the company's long-term investments, such as having idle or redundant assets without them being efficiently used in the revenue generation process. Nevertheless, the company is still doing better than the industry. Solvency, both the equity multiplier and debt to equity ratio tell us that the company has become more levered. From the given numbers, it is hard to give a qualitative judgment beyond observing the drop in leverage. However, a higher leverage imposes additional pressure on the company's profitabilities in an economic downturn. Interest cover of the company in 19 has come down compared to 18, and this is due to the additional pressure on profitability. As a result of further borrowings, however, the interest cover of the company is significantly higher than the industry average. So, that was it. Is so much for question number 5, and we are moving on to question number 6. This is where you can score the highest. Console question for 20 marks. Honex PLC is a large public limited company based in Sri Lanka. It has shareholdings in 2 other companies, Vonex and Linex PLC. Statements of financial positions are shown below for all 3 companies as at 31st March 19. Assets, non-current assets, property, plant and equipment. intangible assets, investments, inventories, trade and other receivables, cash and cash equivalent, stated capital, revaluation reserves, retained earnings, retirement benefit liability, long-term borrowings, other non-current liabilities, trade and other payables, short-term borrowings, total equity and liabilities. The following additional information is to be taken into account insofar as it is relevant. Hon bought 40 million out of the 50 million ordinary shares in Won on 1st April 18 for rupees 11.25 per share. A consultancy fee of 8 million rupees paid on this acquisition was also included in the carrying amount of investments in Hon's financial statements. Hon also bought 20 million out of the 40 million ordinary shares in Lin on 1st July 18, paying an amount of 12 rupees per share plus a transaction cost of 2 million rupees associated with this share purchase. Total payment made on this acquisition was included in the carrying amount of investments in Hon's financial statements. Hon exercises joint control over its investment in joint venture Lin. The stated capital of Won and Lin has not changed since their respective dates of acquisitions. The retained earnings of Won and Lin at the date of acquisitions were 70 million rupees and 58 million rupees respectively. Also, revaluation reserves of Won and Lin at the dates of acquisitions were 130 million rupees and 15 million rupees respectively. Group accounting policies to value non-controlling interest at fair value at the date of acquisitions and goodwill should be calculated accordingly. On 1st April 18, the non-controlling interest in Won was fair valued at 112.5 rupees million. The management assessed that 25% of the value of goodwill in Won was impaired as at 31st March 19. On the acquisition date, the fair value of the assets of Won were equivalent to their carrying amounts with two exceptions: a motor vehicle with a 4-year remaining useful life which was worth 10 million rupees in excess of its carrying value. Also, a land with a carrying amount of 125 million rupees at a fair value of 150 million rupees. These fair value adjustments have not been reflected in the individual financial statements of Won. During the financial year ended 31st March 19, Hon had sold goods to Won amounting to 30 million rupees. These goods were sold inclusive of a profit markup of 25% on cost. 40% of these goods remain in the stock of Won at the reporting date. Since acquiring its holding in Lin, Hon sold goods with a margin of 25% to Lin, which had cost Lin 6 million rupees. All of these remain in the inventory at the reporting date. Carrying value of investments of Hon includes cost incurred on acquisitions of shares of both Won and Lin. The balance amount represents the carrying value of quoted investments made with the expectations of obtaining short-term gains by trading. However, the fair value of these investments at the end of reporting period was 278 million. Ignore tax effects of above transactions adjustments unless specifically stated. Required to prepare a consolidated statement of financial positions of Honex PLC as at 31st March 2019. So, we will write up the balance sheet format and then we will get on with the calculations. Non-current assets, property, plant and equipment. goodwill, intangible assets, we will leave some room here, current assets, inventories, trade and other receivables, cash and cash equivalent, total assets. Stated capital, consolidated retained earnings, consolidated revaluation reserves, non-controlling interest, non-current liabilities, retirement benefit liability, long-term borrowings, other non-current liabilities, current liabilities, trade and other payables, short-term borrowings, we will open up the required accounts. Cost of control, non-controlling interest, consolidated retained earnings, consolidated revaluation reserves, so the reporting date is 31st March 19. So, let us identify what the group structure is with the information given. Hon bought 40 million out of 50 million shares. 40 out of 50 has to be 80%. And if Hon acquired 80% of shares in one, in the absence of any information to the contrary, what is the conclusions you can reasonably arrive at? Hon can consider to have acquired the controlling powers in one. So, one becomes a subsidiary company within the group. So, as a result, let me also open up subsidiary companies' retained earnings. And then it says, Hon bought 20 million out of 40, it has been exactly 50%. And then the adjustment number 2 says explicitly, Hon has been able to exercise joint control in company lien. Now, see how helpful the examiner has been, without letting you yourself to decide whether it was significant influence or joint control. If it is joint control, whether it is a joint operations or joint joint operations or joint venture, the examiner himself has done a lot of work for you all, and he himself says Hon has acquired joint control over company lien, and company lien becomes a joint venture for company Hon. And if it is a joint venture, you know what techniques to be used to recognize the investment lien in the books of company Hon. It has to be equity method. It is as if lien is an associate. This is not an associate, but the accounting for an associate and the accounting for a joint venture is exactly same to the last decimal point, all in all, through and through, no difference at all. So, this is what the examiner does to pass, to increase the not that we bring down the standard level, but the examiner has tried to make things clear and to stretch his helping hand to almost to every student at the exam by making the paper as detailed as possible. So, do not put the blame on the examiner, on anyone else. It is our fault for not being able to score 50 marks. So, then we will open up investment in joint venture and revaluation reserve of the subsidiary company. We will pick the figures to the accounts as opening balances. Parent company's retained earnings 760,000, say opening balance of consolidated retained earnings. Subsidiary company has a profit figure of how much? 114,000. Subsidiary company retained earnings 114,000. Let us take it as their opening balance, 114,000. Revaluation reserves of the parent company is 220. Let me bring it to consolidated revaluation reserve account, 220,000. 220,000. Right. Reporting date is on 31st March 19. Acquisition date has been on 1st April 18, exactly 1 year before the reporting date. So, that information will be absolutely important within the 15 minutes reading time. Especially you need to pay attention to the group to identify the group structure, acquisition date, reporting date, in between the number of years, why they are important in deciding the how the fair values are determined, how depreciations on fair values are determined. So, do not waste that 15 minutes, make the best use of make the best out of the 15 minutes reading time. Now, first adjustment says Hon bought 40 million out of 50 million ordinary shares in one on 1st April 18 for 11.25 rupees per share. Let me work out on cash consideration, 11.25 into 40 million. So, I will take the figures in 1000 because even the question has been given in 1000. So, investment has to be 450,000. Will credit investment and debit to cost of control 450. And also let me open up another simple account, parent company's investment account. Investment Parent company's balance sheet has an investment account, balance of how much? 980,000. Out of this 980,000, let me transfer 450,000 to cost of control for the goodwill calculation. A consultancy fee of rupees 8 million paid on this acquisition was also included in the carried amount of investment in HON's financial statement. 8 million consultancy fees. SLFRS 3 says the consultancy fee share valuation charges incurred on the acquisitions cannot be included into the investment figure. Please expense it to the profit and loss immediately and deduct it from the profit of the year in which the cost has been incurred. So, this 8 million consultancy fees has to be taken off from investment account and debited to parent company's profit and loss, that is consolidated retained earnings are debited by 8,000. Consultancy 8,000. Second adjustment, HON also bought 20 million out of 40 million in Lin on 1st July 18, that is during the current year being concerned, just 9 months ahead of the reporting date. It has occurred during the current year, paying an amount of 12 rupees per share. So, let us work out on the investment in joint venture. 40,000 into 12, how much? 480,000. Let me bring that to investment in joint venture account. 480 investment, and will credit that to parent company's investment account. 480,000 is credited there, say investment in joint venture, right. Similarly, investor company HON has incurred some acquisition cost in acquiring the shares of joint venture as well. How much? It has been 2 million rupees, transaction cost 2 million. SLFRS 3 says consultancy fee, transaction cost, share valuation cost incurred in business combinations cannot be included in investments, and you need to recognize and deduct it from the current year's profit. I mean the profit of the year in which the cost was incurred. So, we need to deduct that 2,000 as well, will credit to investment account and debit where transaction cost is debited to consolidated retained earnings. 2,000 is debited to consolidated retained earnings, say transaction cost. Third one, the stated capital of WON and Lin has not changed since their respective dates of acquisition. The retained earnings of WON and Lin at the dates of acquisitions were 70 million rupees and 58 million rupees respectively. Subsidiary company's profit on the acquisition date 70 million. Let me debit to subsidiary company's profit and credit to cost of control. 70 retained earnings of the subsidiary company. Joint venture profit has been 58 million. So, once and for all, let me calculate subsequent equity changes of the associate company or rather joint venture. Joint venture has retained earnings of 85 million today minus the profit on the acquisition date has been 58 million. So, for equity method of accounting, subsequent equity changes need to be recognized. 85,000 minus 58,000 into 50%, 13,005. 13,005 will debit to investment in joint venture by 13,500 and will credit to consolidated retained earnings 13,005. Share of joint venture profit share of joint venture profit. Then also revaluation reserves of Won and Lin at the date of acquisitions were 130 and 15 million respectively. So, we will bring those reserves as well to cost of control as is required for the goodwill calculation. Subsidiary companies revaluation reserve on the reporting date is 162,000. Let me bring that balance to their account. 162,000. So, what does it say? The balance of the reserve has been on the acquisition date. Balance of the reserve on the acquisition date has been 130 million. Will transfer it to cost of control, debit to revaluation reserve and credit to cost of control. 130,000. Revaluation reserve of the subsidiary company. And so should be associate company. The balance of the reserve of the, not the associates, I beg your pardon, it has to be the joint venture. The revaluation reserve of the joint venture on the acquisition date has been 15 million, now it is 28 million. So, once again we will recognize subsequent equity changes 28 minus 15 into 50%. 28 minus 15 into 50% should be 6,500. We will debit it to investment in joint venture account 6,005. Share of revaluation reserve and we will credit that to consolidated revaluation reserve account 6,005. Share of joint venture revaluation reserve 6,005. Number 4, group accounting policies to value non-controlling interest at fair value at the date of acquisitions and goodwill should be calculated accordingly. On 1st April 18, the non-controlling interest in Won was fair valued at 112,500,000. 112,500,000 NCI, this is the fair value. So, we are calculating the full goodwill, debit cost of control and credit to NCI by 112,500. If I were the examiner, I would not give these figures directly. I would obviously give you to calculate fair values of NCI and then to do the accounting. Here the examiner has been so kind-hearted. The management assessed that 25% of the goodwill in Won was impaired as at 31st March 9. So, let me first complete the goodwill calculations and come back to the impairment review and the process. Right. Number 5, on the acquisition date, the fair value of the assets of Won were equivalent to their carrying amounts with 2 exceptions. A motor vehicle with a 4-year remaining useful life which was worth 10 million in excess of its carrying value, also a land with a carrying amount of 125 million rupees and a fair value of 150 million. So, there are 2 assets where the fair valuations are required. One is the motor vehicle, of which the fair value is higher by 10,000 rupees than the book value. We will recognize 10,000 to property, plant and equipment, and we will recognize it to cost of control account as well, fair value reserve of motor vehicle. Similarly, there is a land of which the market value is higher than the book value. So, what does it say? The book value is 125 and the fair value is 150. So, we should recognize another fair value reserve of 25,000 to cost of control. Fair value reserve of lands will credit that to cost of control and debit it to property, plant and equipment 25,000. 25,000. So, land need not to be depreciated, but motor vehicles need. So, you need to recognize excess depreciations requirements arising out of fair valuations, how much 10 million is what has to be depreciated over the remaining life of how many years? 4 years. So, we should recognize 1 year's depreciation. 10,000 divided by 4 into 1 should be 2005, will credit to property, plant and equipment and debit to subsidiary company's profit figure. 2005 depreciation on fair valuation, 2500, 2005. Then I can complete the goodwill calculation once and for all and proceed with the remaining couple of adjustments. Let me bring subsidiary company share capital to cost of control. Share capital is 275. So, make sure I have taken all the required figures. Investment was taken, NCI was taken, retained earnings, reserves, fair valuation, share capital, fine. So, we can close up the goodwill, close up the account now. 0, this is 0, 5, 2, 6, 562, 500, 562,005, goodwill 562,005 minus 70,000 minus 130,000 minus 10,000 minus 25 minus 275,000. It has to be 52,500. Goodwill should be 52,005. And what it says is that 25% is estimated to have been impaired, and that has to be recognized now. 52,005 into 25% should be 13,125 minus 13,125, and will debit it to subsidiary companies retained earnings. 13,125 goodwill impairment. Goodwill impairment should be 13,125. Then number 6 adjustment. During the financial year ended 31st March 19, Hon had sold goods to one amounting to 30 million. These goods were sold inclusive of profit markup of 25% on cost. 40% of these goods remain in the books of Hon at the reporting date. We will recognize unrealized profits. $30 million has been the value of goods sold, and we should recognize unrealized profits only on the remaining inventories of 40%. 30,000 into 40%, what has been the profit markup? Profit markup has been 25%, divided by 125 into 25. 30 into 40 divided by 125 into 25 should be 2,400, debited to consolidated retained earnings. The unrealized profits need to be deducted from the selling company. Since the parent company was the selling company, we are deducting unrealized profit from consolidated retained earnings. And also we will deduct it from the inventories, minus 2,400 from inventories. Then Hon sold goods with a margin of 25% to Lin, which had a cost of 6 million rupees. All of these goods remain in the inventory at the reporting date. So, the transactions between the investor and the joint venture has been 6 million rupees worth, and all the goods remain in the books of the joint venture at 6 million rupees. Remember, here the examiner says it is not the profit markup, it has been the profit margin. So, be careful, those tiny things will matter the most at the exam. You will not pay sometimes the required attention to those areas. 25% is not the markup, it has to be the margin. 6 million, all the goods remain unsold, into 25%, we recognize unrealized profit only to the extent of the share of the investor, that is 50%. So, 6,000 into 25% into 50%, 750, will debit it to consolidated retained earnings by 750, say unrealized profits, and will credit where? Credit depends on the fact who sells and who buys. Since the investor sells and the joint venture buys, you need to credit that to investment in joint venture account, 750, unrealized profits. Right. Seventh one, carrying value of investments of HON includes cost incurred on acquisition of shares of both WON and LIN. The balance amount represents the carrying value of quoted investments made with the expectations of obtaining short-term gains by trading. However, the fair value of these investments at the end of the reporting period was 278. Now, the parent company had an investment value of 980, which is including the investment made in subsidiary company, investment made in the joint venture, and that was also including the transaction cost incurred and the consultancy fees. They all were removed, and whatever the balance of investments to be left over are said to have been the investments made in other companies to acquire equity shares of other companies for trading purpose. So, what does the examiner try to make you understand? The remaining investments has to be nothing but investments of equity to be classified under fair value through profit and loss. So, the closing or the subsequent measurement should be fair value, which is given in the question 278, and let me bring the balance of investment 278, and any balancing figure should be the fair value change. Before I forget, let me bring that 278,000 to balance sheet under current assets. 278 investments in equity shares. Investments in equity shares. So, let me close up the account to see what the missing figure is. 980 minus 450 minus 8,000 minus 480,000 minus 2,000 minus 278,000 450 was taken off, investment in joint ventures was taken off, consultancy, everything was taken off. So, 980,000 minus 450 minus 8,000 minus 480,000 minus 2,000 I have made a mistake here. The joint venture investment should not be 480, it has to be 240,000. Please do the correction. It has to be 20,000 shares into 12 rupees. 240,000. Please do the corrections and then let us see the balancing figure. 980,000 minus 450 minus 8,000 minus 240 minus 2,000 minus 270. So, there is a balancing figure of 2,000 and that is supposed to be the fair value change, and let me put it here. Fair value changes, and let us debit it to parent company's profit 2,000. Fair value changes of investments, fair value changes of investments 2,000. Last one, ignore tax effects of above transactions adjustments unless specifically mentioned. There is nothing to be done in relation to 8th adjustment. So, we can close up the accounts and to find out, or we can close up the balance sheet also. We will close up the accounts now. Close up subsidiary companies retained earnings, credit 114,000. We will take it to debit side 114,000. Take the balancing figure 114,000 minus 70,000 minus 13,125. 30,875. 80% should go to parent and 20 goes to NCI. This into 80% is 24,700. Will credit consolidated retained earnings by 24,700, subsidiary companies retained earnings. 30,875 minus 24,007 is 6,175. That should go to NCI. 6,175, subsidiary companies retained earnings. Then we will close up subsidiary companies revaluation reserves. 162,000. 162,000. Let us take the balancing figure. 162,000 minus 132,005, 29,500 into 80% is 23,600, 23,006. 5,900 should go to NCI. Credit NCI by 5,900. Subsidiary companies revaluation reserves. Credit the balance amount of 23,600 to consolidated revaluation reserves. Subsidiary companies revaluation reserves. We will close up NCI. This is 5, this is 7, 5, 124,575. 124,575 will bring it to the balance sheet. Non-controlling interest 124,575. Consolidated revaluation reserve. 0, 0, this is 1, 0, 5, 250,100. 250,100. Bring it to the balance sheet. Consolidated revaluation reserves 250,100. Consolidated retained earnings 760,000 plus 13,005 plus 24,007, it's 798,200. 798,200 minus 8,000 minus 2,000 minus 2,400 minus 750 minus 2,000. So, the balance has to be 783,050. 783,050. Close up investments in joint ventures, 240,000 plus 13,005 plus 6,500, it's 260,000. 260,000 minus 750, 259,250. Bring it to the balance sheet. Investments in joint ventures, 259,250. Here there has to be a correction to be done. Subsidiary companies revaluation reserve, the balancing figure, I have made a mistake. The depreciation on motor vehicles revaluation has to be in the profit account. I have debited that to the reserve account. Please do the correction. It has to be debited to retained earnings, say depreciation on motor vehicles. Revaluation reserve has to be 32 into 80% is 25,006. Non-controlling shareholders amount should be 6,004. Revaluation reserve of subsidiary company should be 6004, and then let me also close up subsidiary companies retained earnings. Let us see the balancing figure. 114,000 minus 70,000 minus 13,125 minus 2,005, 28,375 into 80%, 22,700. 20% should be 5,675. Subsidiary companies retained earnings should be 22,700. Non-controlling interest should be credited by 5,675. We will take the total of NCI, $124,000 575. Okay. 124,575. Consolidated revaluation reserves this has to be 25,600. 25,006 plus 6,005 plus 220, 252,100. 252,100 revaluation reserves. Consolidated retained earnings. $760,000 plus 13,005 plus 22,007. 796,200. 796,002 minus 8,000 minus 2,000 minus 2,004 minus 750 minus 2,000, 781,050. So, the balances in the balance sheet: property, plant and equipment 1,672,500, goodwill 39,375, intangible assets 235,000, investments in joint ventures 259,250, inventories 277,600, trade and other receivables 250, investments in equity shares 278, cash and cash equivalent 55, stated capital 710,000, consolidated retained earnings 781,050, consolidated revaluation reserves 252,100, non-controlling interest 124,575, retirement benefit liability 220,000, long-term borrowings 280,000, other non-current liabilities 116, trade and other payables 475, short-term borrowings 108,000. Balance sheet total is 3,066,725. So, we can move on to question number 7, the last question. Question number 7, the last question. Winnie PLC is in the process of preparing financial statements for the year ended 31st March 2020. The following accounting issues are yet to be resolved. First one, Winnie PLC has relocated its operations in Horana to Malambi. Due to this, land and buildings used as the head office in Horana was rented out to a third party on 1st August 19. Winnie PLC measures land and buildings at fair value irrespective of the classifications as property, plant and equipment or investment properties. The following details are relevant for the head office property which is currently shown under property, plant and equipment. Fair value as at 31st March 2020 is 350 million rupees, land 230 million, building 120 million. Fair value as at 1st August 19 is 300 million, land 210 million, building 90 million. Fair value as at 1st April 19, 270 million, land 200 million, building 70 million. As at this date, remaining useful life of the building is 15 years. Cost of the property is 102 million rupees, land 50 million, building 52 million. Second part, Winnie PLC has a pension plan for its employees. The following details are relevant to the pension plan. Fair value of the plan assets and the present value of the pension liability as at 1st April 19 were 12.1 million rupees and 12.5 million rupees respectively. Current service cost for the year ended 31st March 2020 as estimated by the actuary is 1.2 million rupees. Past service cost due to the change in the pension plan so as to increase benefits, vesting is immediate, as estimated by the actuary is rupees 1 million. Expected return on plan assets is 8%, whereas discount rate used for pension liability is 11%. During the year, rupees 5 million was paid as benefits to the members of the plan. Winnie PLC paid 4 million rupees as contribution to the pension plan, including the past service cost of 1 million. Fair value of the plan assets and the present value of the pension liability as at 31st March 2020 were 13.1 million and 14.5 million rupees. Third one, on 1st April 19, Winnie PLC entered into a 4-year lease arrangement to obtain the use of an asset. Winnie PLC was required to pay 1.2 million rupees annually in advance. Winnie PLC's incremental borrowing rate is 8%. The asset has a useful life of 10 years. There is no option available to Winnie PLC to purchase the asset at the end of the lease term. At the commencement of the lease, Winnie PLC received a lease incentive of 50,000 rupees for this lease and incurred a direct cost of 30,000 rupees. Advised on the accounting treatment for the Horana property referred to in 1 above for the year ended 31st March 2020, recommend how the pension plan referred to in 2 above should be recognized and presented in the financial statements for the year ended 31st March 2020 with reference to the given information. Assess the impact to the financial statements for the year ended 31st March 2020 from the lease arrangements in 3 above if Winnie PLC applies SLFRS 16 leases. Right. Now, to answer first part of question number 7, what do they want us to do? The examiner requires us to advise, to provide the best course of actions. We will open up 2 accounts, land and buildings. Let me start from the cost, from the last line of the fair valuations given. Cost of the property 102 million, land 50 million, 50,000, and the building has to be 52 million. Building should be 52 million. Right. Now, Winnie PLC has relocated its operations in Horana to Malabe. Due to this, land and buildings used as the head office in Horana was rented out to a third party on 1st August 2019. So, what is its significance? Its significance is that right until 1st August 2019, the properties would have been under property, plant and equipment, but since there are changes, there are evidences for the changes in use of the properties, you need to transfer properties from property, plant and equipment to investment properties. Now, we bought it sometimes back at the cost of 50 million rupees for the land and 52 million rupees to the building. So, you need not to depreciate the lands, but you need to keep depreciating the building 52 million rupees. Now, it says fair value as at 1st April 19 is 270, land 200 million. So, let me revalue land. This is on 1st April 2019. We first revalue the property on 1st April 19, 150 million rupees to the land, and the building has to be revalued from 52 million rupees to 70 million rupees. So, we recognize another 18 million revaluation gain. 1st April 19, revaluation gain, revaluation gain. So, the land value 200,000, 200,000, balance 200,000. Building 70,000, 70,000, here the balance has to be 70,000, balance should be 70,000. So, that was as at 1st April 19. Fair value 1st August 19 is 300. So, that is the date on which you transfer the properties from property, plant and equipment to investment properties. Property, plant and equipment are carried at fair value or revaluation model. Investment properties are carried at fair value model. So, before you transfer properties from LK 16 to LK 40, you need to first complete the revaluations and then to transfer it to investment property. So, now since you revalue it before you transfer it to investment properties, your revaluation should still be under LK 16 property, plant and equipment. Land, no depreciation, land value has risen from 200 to 210 million, revaluation gain should be 10 million, that should go to equity. Building, you need to start depreciating starting from 1st April 19 over how many years? 15 years time. So, let me recognize depreciation 70,000 divided by 15, that is the annual depreciation starting from 1st April 19 to 1st August 19. How many months? April, May, June, July, 4 months divided by 12 into 4, 1.55, 1,555 depreciation is recognized, and will revalue it 70,000 minus 1,555, 68,455. So, the revaluation gain has to be how much? 90,000 minus this, will recognize 21,555 revaluation gain, revaluation gain. Now, let me close up 210, this is 91,555, 91,555, balance has to be 90,000, will transfer both of them to investment properties now. Transfer to investment properties, credit property, plant and equipment 210,000, debit to investment properties, and so should be building credit to buildings account and debit to investment properties. You credit to PPE and debit to investment properties, so that we have a balance of 300,000 rupees, 300,000 on 1st August 2019 on the date of the transfer. It has to be 300 million. Then we continue to apply fair value model for investment properties. By 31st March 2020, total fair value has been 350 million. That 50,000 or 50 million fair value gain should be recognized to profit and loss. Why? Fair value changes of investment property should go to profit and loss. So, this is not your final answer, and this is just a working only. So, what should be? You need to give instructions on accounting because the examiner requires us to advise. So, what shall we do? You need to say that right until 1st August 2019, the date of the change of the use, the property should be recognized under property, plant and equipment, and for subsequent measurement they are using revaluation model. So, you need to provide the informations. The revaluations gains you recognized, 150,000 and 10,000 for the land, and 18,000 and 21,555 for the building. Then, since there are evidences for the change in use of the property, on 1st August 2019, 1st August 2019, you need to transfer it from property, plant and equipment to investment properties. So, right up to the date of the transfer, right up to the date of the change in use, properties are measured using revaluation model under LK 16. So, all the revaluation gains are recognized to equity, and after it being transferred to investment properties, the entity continues to apply fair value model for investment properties, and then the fair value changes are recognized to profit and loss. Profit and loss. So, let us look at the answer of the examiner. Since the property was rented out on 1st August 19, there is a change in the use of the property per L case 40. It should now be recognized as an investment property, end of owner occupations, and a transfer from an owner occupied property to an investment property. If an owner occupied property becomes an investment property, it will be carried at fair value, which is also the case here, and LK 16 should be applied up to the date of change in use. So, the calculations I did in T accounts are given here. The fair value, above fair value increase should be recognized in other comprehensive income. Increase in the revaluation surplus within equity. As at 31st March 2020, the property should be measured at fair value 350 million rupees, and the fair value change should be recognized in the income statements 50 million, right. Then second part, Vinny PLC has a pension plan for its employees. The following details are relevant to the pension plan. Fair value of plan assets and liabilities are given. So, let us see what the examiner requires us to do. Recommend how the pension plan referred to into above should be recognized and presented in the financial statements for the year ended 31st March 2020. Right. So, we need to first complete the accounting for the plan assets and the plan liabilities. Let us open up two accounts. Plan assets and plan liabilities. Fair value of the plan asset and the present value of the pension liability as at 1st April 19, beginning balances are given. 12,100,000 fair value of the plan assets at the beginning of the year. Present value of the plan liabilities at the beginning of the year is 12,500,000. Current service cost for the year ended 31st March 2020 as estimated by the actuary is 1.2 million. current service cost 1200, that should go to profit and loss 1200, and past service cost due to the change in the pension plan so as to increase benefits vesting immediately as estimated by the actuary is 1 million rupees. Even the past service cost should be recognized to profit and loss. So, what does the examiner say the value has been? Past service cost is 1 million rupees. 1 million rupees. Expected return on plan asset is 8%, whereas discount rate used for pension liability is 11%. So, let me recognize interest cost at 11% on the opening balance 12,005 into 11% is 1,375 interest. 1,375. We will also recognize return on plan assets, that should also go to profit and loss. Return on plan assets. So, that is at what percentage? 8%. Opening balance is 12,001 into 8% should be 968. During the year, rupees 5 million was paid as benefits to the members of the plan. Benefits paid. As you pay benefits, the liability value drops. How much has been the amount of benefits paid? 5 million. Debited to plan liabilities. So should be plan assets. As you pay benefits, the plan assets value should come down. 5,000 benefits paid. Benefits paid 5,000. Winnie PLC paid 4 million rupees as contribution to the plan, including the past service cost. Contributions during the current year 4 million will add it to the plan assets. Contributions during the year. Contributions are 4,000. Fair value of the plan assets and the present value of the pension liability as at 31st March 2020 were 13.1 million and 14.5. Closing balance. Plan assets 14,005. Very mistake. 13,001. 13,001, and the present value of the plan liabilities at the end of the year should be 14.5. Now, any missing figures in the two accounts should be actuarial gains or loss, and we will work out on that. Plan assets will take the credit total 18,100. 18,001. 18,100 minus 12,001 minus 968 minus 4,000, that should be 1,032. Actuarial gain. Actuarial gain. Also, we will close up plan liabilities 19,005. 19,005. 19,005 minus 12,005 minus 1,002 minus 1,000 minus 1,375 should be 3,425. Actuarial loss. Actuarial loss. Then just see the items to be recognized to profit and loss. Extract of the profit and loss. Current service cost. Current service cost 1200 should be a debit to profit and loss. Past service cost. Past service cost is 1000 should be a debit to the profit and loss. Net interest cost. Net interest cost 1375 minus 968. 1375 minus 968 should be 407. Other comprehensive income. Other comprehensive income. So, the net actuarial gains and losses are recognized to other comprehensive income 3425 minus 1032. It has to be 2393 net actuarial loss. Net actuarial loss. Then in the balance sheet, we will recognize defined benefit liability. What is the closing balance? 14,500 minus 13,100. Non-current liabilities, say extract of the balance sheet, extract of the statement of financial position, net benefit liability, net benefit liability 13,500 minus 14,500 minus 13,100, it is 1,400. 1,400. Then we are moving on to number 3, third part of the question number 7. On 1st April 2019, Winnie PLC entered into a 4-year lease arrangement to obtain the use of an asset. Winnie PLC was required to pay 1.2 million rupees annually in advance. Winnie PLC's incremental borrowing rate is 8%. The asset has a useful life of 10 years. There is no option available to Winnie PLC to purchase the asset at the end of the lease term. At the commencement of the lease, Winnie PLC received a lease incentive of 50,000 rupees. For this lease and incurred a direct cost of 30,000. Assess the impact to the financial statements for the year ended 31st March 2020 from the arrangement in 3 above. Right, impact to the financial statements. Before you assess the impact, you need to calculate the value of the lease liability and the right of use of the asset. We will first calculate lease liability. To calculate the lease liability, what will you do? You take the rent, simple question, 1.2 million, 1.2 million, and this is to be multiplied by the annuity factor at the rate of 8%, 1 minus 1.08 to the power 4 divided by 0.08, and this has to be multiplied again by 1.08. 1.08 to the power minus 4, 1 minus this divided by 0.08, into 1.08 into 1,200,000. So, the lease liability should be 4,292,560, and we will open up the right of use asset and lease liability account. Lease liability account. Debit right of use asset by 4,292,516 and credit to lease liability by 4,292,516, and for the right of use asset you need to add the direct cost of 30,000 minus the incentive of 50,000 rupees. Incentive should be deducted 50,000. Direct cost is added and incentive should be deducted. 516, this is 2, this is 2, 3, 4,322,516, 4,322,516 minus 50,000. The right of use asset at its initial recognition should be 4,272,516. This is at the cost of the right of use asset should be 4,272,516. Right. And to assess the financial impact, you need to do some more calculations. What are those? Now, since the rentals are paid in advance, this is the year 0, first year end, second year end, third year end, the fourth year end. Right at the beginning of the lease agreement, the first installment would have been paid. Remember, that was paid as soon as the lease agreement was entered into, not at the end of the first year. So, right at the beginning, the value of the lease liability should be, after deducting the first installment being paid. So, the value of the lease liability at the beginning should be how much? 3,92,516. 3,92,516. And let us work out on interest for the first year. This has to be the lease liability at this point, 3,92,516, and we will work out on interest on this outstanding balance for the first year. 3,92,516 into 8%, interest has to be 247,401, 247,201. And let us also work out on depreciation. Now, the lease agreement says specifically that the lessee does not get the legal title of the asset. There is no option available to Vinny PLC to repurchase the asset, to purchase the asset at the end of the lease term. So, what it says is the lessee has to return the asset to the lessor end of the lease term. So, the asset has to be depreciated over the lower of economic lifetime and the lease term. Now, what will happen is here, since the lessee has to return the asset back to the lessor in 4 years time, lessee cannot make the best use of the asset over 10 years time. So, whatever the lessee can do, lessee can make the best use of the asset only over 4 years time. So, you need to depreciate the asset only over 4 years time. So, let us calculate the depreciation 4,272,516 divided by 4. Annual depreciation has to be, annual depreciation figure should be 1,68,129. So, for the first year, what is the total impact on the profitability? Depreciation plus the finance charge. Finance charge 247,401. Take the total 247,401. Total impact to the profits in the first year will be 1,315,530. 1,315,530. So, you need to show the right of use asset at cost minus cumulative depreciation, and lease liability has to be recognized to the balance sheet by splitting the lease liability into current liability and non-current liability depending on how soon these lease liabilities will become due. So, that is the perfect answer for question number 7. So, with that we conclude our discussions of the paper 2021 February. I hope this would have been useful for all of you all. Thanking you for watching our webinars videos, and hope to see you again in the future.